do we need to start worrying about the e-commerce space? Last night we had not one, but two calls that made you feel like maybe it's getting too tough to be in this business, that it's getting too much competition, at least in terms of predicting where the business is going. I mean, I'm talking about FedEx and Adobe. Wow. Now, if you listen to both conference calls after their quarters, you know it's ridiculously unfair for me to lump Adobe in with FedEx. Adobe delivered a generally solid quarter. We had Chandran Ryan on, the CEO. They just made some missteps in their customer experience management business, especially the parts of the business they got when they acquired Marketo last year. Plus, their bookings were a little light. Consulting services disappointed. Sure, the headline numbers were strong, but there were some areas of weakness that prevented the company from raising its forecast. Instead, they trimmed it ever so slightly. While Adobe's arguably the cheapest of the big cap cloud plays, stock sells for nearly 29 times next year's earnings estimates. And it's not like it's an incredible bargain. If management can't address these booking problems by their analyst meeting on November 4th, I think the price earnings multiple might be hard to maintain. Hence why the stock dipped $5 today, but was down a lot more at one point. Still, Adobe's basically a healthy company that stumbled on a couple of line items. I think you buy the stock into weakness ahead of that conference. FedEx, on the other hand, this was a total meltdown. Sell. From start to finish, stock fell $22 or 12.9%. Sheesh. Why the obliteration? In part, it's because this great company can't predict what will happen to worldwide commerce, seeing as we've got no clarity whatsoever on the trade war with China, which is a big, big place for FedEx business. FedEx CEO, the super smart Fred Smith, was openly bemoaning how tariffs are slowing down the whole global economy, and we're next. Thank heavens Jay's listening. Jay Powell, not Jay Leno. I'm not usually confused. Look, I support the trade war. We need to crack down on China's unfair practices. But there's a cost to that. And Smith's not wrong when he points out that, for example, Germany's weak because China's weak. And remember, FedEx is in all these areas. It's a truly international, triumphant company that I'm proud of. That said, FedEx reported a huge shortfall, also slashing its guidance for good measure. And the analysts believe that there was more to do with execution than Smith is willing to admit. There was open rebellion on this conference call, the type of criticism you only hear when the analysts feel that they've been completely hosed by management's poor forecasting and definite suboptimal execution. And that's why the stock was pummeled. My view, I want to be more forgiving. FedEx is in an impossible position. Their chief competitors, UPS, DHL, the Post Office, Amazon, constantly innovating, tough guys. FedEx is trying to fight all four of them on every front, and it's costing them a fortune. Plus, the company dropped the last bit of its Amazon business, which is surprisingly profitable for now, but at a big cost down the road, given what Amazon's asking for. While this is only a small piece of the pie for FedEx, only 1.3% of the company's total revenue, in the near term, Smith says it means his earnings will take a meaningful hit, and that did come as a bit of a shock. I thought that was not so great. When you combine the Amazon surprise, the amount of money FedEx is shelling out for capital expenditures, the higher labor costs experienced in this country, and the company's overall inability to fully integrate its European business and be able to predict anything, you can understand why the analysts were furious. But I got a different takeaway. I mean, everyone's got that consensus view. I'm taking something different here. I think what's happened is the competition for e-commerce, no matter where it is, whether it be software, whether it be freight, has gotten very intense, ultra intense, whether it's Adobe's digital marketing software versus, say, Salesforce, or FedEx's shipping versus UPS. For example, as Heather Bellini, who's an excellent analyst from Goldman Sachs, wondered on the Adobe call, maybe there's just some competition to the Marketo end of the business that's causing problems. In her shoes, I probably wouldn't have been as diplomatic and just asked if Salesforce was gunning for him. Sure seems like that's the case. And if you're running a business, the last thing you want is serious competition. Now, I think FedEx may have the same problems. The rivals may be cherry-picking the good parcels and leaving FedEx to deliver on the lots that are less profitable. At the same time, the global economy is slowing down when FedEx was ramping up to meet worldwide e-commerce demand that's now no longer materializing because of the softness of the world's economies. Both business to business and consumers are issues for FedEx. The former because of a slowdown in the industrial economy, the latter because it's just too darn expensive to get it right. But with FedEx and Adobe getting hammered today, I want to be a little gentle about their misses, unlike all the other jackals. The fault is not in themselves. In this case, it's in their stars, specifically the competition in an ever-evolving e-commerce world that makes it incredibly difficult to forecast how well you're going to do. It's this competition that fell both FedEx and Adobe at the same time, although one obviously fell a lot harder than the other. Mad Money's back into the break. Do you think my combine's sexy? We're talking agriculture, farm equipment, everything you need to know with Martin Rieschenhagen, the CEO of AGCO. Stay tuned.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.